Good morning, hunters. Welcome to the Daily Hunt for Multibaggers, your go-to for AI-generated market insights. It's Tuesday, February 3rd, 2026, and we're looking at all the data our systems collected yesterday, Monday, February 2nd.
And what a day it was, Ethan. Our AI flagged a substantial number of discussions, with chatter spiking across a wide range of companies. The overall sentiment is definitely a mixed bag. We're seeing incredible bullishness in certain high-growth tech sectors, but also significant caution and even outright skepticism for others.
Absolutely. Lots of intriguing leads and a few head-scratchers as always. Let's dive in. First up, let's talk about Western Digital, WDC. Our data shows strong bullish sentiment for WDC and the entire memory sector, with users calling them free money and predicting sustained growth into 2026. This really aligns with the analyst upgrade to $330 and WDC's focus on AI storage, positioning them in a high-demand sector. Previously, we've rated WDC as a buy.
Well, Ethan, while that community enthusiasm is palpable, it's worth noting the stock's currently trading near its 52-week high, and the price-to-book ratio is pretty stretched at almost 13. However, I have to admit, their return on equity is an outstanding 0.41, and that net profit margin of 0.35 is robust. Plus, insiders have been net purchasers, buying over 87,000 shares, which is a strong signal. The AI story truly could improve their already impressive KPIs.
Exactly. Given those strong fundamentals and the clear market momentum, my verdict for WDC is a buy.
Next, let's look at Tesla, TSLA. The post we analyzed highlighted a $2 billion investment in xAI and reaffirmed Cybercab production by 2026, framing it as a transformation into an AI company, supporting a $1.5 trillion valuation. That's a bold vision, Ethan.
It really is, Brooke. Elon Musk is pushing them into humanoid robots and autonomous services with massive capital expenditure plans. Some analysts even see potential for TSLA to hit 500. This kind of vision is what drives growth. We've rated TSLA as a stay away or speculative gamble many times before, so this is an attempt at an optimistic angle.
Yes, but this vision comes at a significant cost, and the KPIs are frankly alarming. A price-to-earnings ratio of 383 is astronomical, implying perfection that current performance doesn't support. We're seeing negative revenue growth, and a sky-high debt-to-equity ratio of 17.76 indicates substantial financial leverage. While the AI ventures could turn these around, it's a huge speculative leap. For a company valued for future perfection, I see too many current red flags.
I hear you. The market definitely has a lot riding on those future promises. My verdict for TSLA has to remain a stay away for now. Moving on to Microsoft, MSFT. Our data points to strong innovation with the release of their new Maya 200 AI chip. Users are also commenting on MSFT's blue chip status, with some looking for buying opportunities after a recent dip. We've had mixed ratings for MSFT recently, from buy to cautious buy and even a stay away, so this could be an important update.
Well, the numbers certainly back the blue chip claim. Microsoft boasts an excellent net profit margin of 0.39 and robust revenue growth of 0.167. Their return on equity is impressive at 0.34, demonstrating great capital efficiency. Plus, insiders have been net purchasers of over 432,000 shares, showing strong internal confidence, especially after the stock pulled back from its 52-week high. While there's chatter about high capital expenditures and past cloud revenue shortfalls, the underlying financial health and direct technological advancement in AI suggest those investments are strategic.
That's it, Brooke. The Maya 200 chip is a huge play in the AI inference market. This strategic positioning, combined with the financial strength and insider confidence, makes me think those short-term pain concerns some users have about options are missing the bigger picture. The long-term equity play here is compelling. My verdict for MSFT is a buy.
Next, let's evaluate Supermicrocomputer, SMCI. The user comments are pretty dire, Ethan, with mentions of having missed earnings last 4 times, making current investments feel like a YOLO bet. Previously, we've classified SMCI as a stay away or a speculative gamble.
Right, but there's a forward-looking aspect. News suggests traction in AI GPU platform could propel SMCI's Q2 earnings, with some analysts seeing room to outperform. Insider buying has also been positive. It's an earnings play, yes, but if they deliver, it could be a significant turnaround.
If is the keyword there, Ethan. Currently, revenue growth is negative at negative 0.155, and the stock is trading perilously close to its 52-week low. Their debt-to-equity ratio is a very high 79.18, which is a major concern for a company struggling with profitability. While the AI GPU platform is promising, the current KPIs and a history of missed earnings make it far too risky until we see concrete proof of a turnaround in the upcoming earnings report today.
Fair enough, Brooke. My verdict for SMCI, at least for now, is stay away. Let's look at Micron Technology, MU. The community is buzzing, calling memory stocks literally free money and highlighting massive gains. We've seen a mix of speculative gamble and buy ratings for MU in the past, but the recent sentiment is overwhelmingly bullish. Well, it's hard to ignore the 0.567 revenue growth, which is phenomenal, and insiders have been heavily buying, with over 860,000 net shares purchased, accounting for over 31% of total insider holdings. Their operating and net profit margins are also very healthy. That's solid. And the news backs it up. Headlines like Micron Technology soars again and Micron deepens AI memory bet clearly show strong market and strategic tailwinds. The AI sector is driving this, and Micron is right in the thick of it. While the PE ratio of 41.65 is high, reflecting significant future growth expectations, those strong insider buys and the impressive revenue growth suggest that the market's optimism isn't entirely unfounded. Given the momentum and insider confidence, the potential for these positive trends to continue makes it compelling. Agreed. My verdict for MU is a buy. Next up, Advanced Micro Devices, AMD. The original post mentions NVIDIA's new SOCs as a competitive threat to AMD's x86 dominance, which sounds a bit concerning. However, the wider news suggests AMD is expected to exceed Q4 earnings estimates, with some calling it a top buy AI stock. Our previous ratings have mostly been stay away or cautious buy, with a few buys. Well, that initial competitive threat needs to be taken seriously. And while there's bullish news, a PE ratio of 128.27 is extremely high, indicating a lot of future growth is already priced in. Their debt-to-equity ratio is also quite high at 6.36. While they have strong revenue growth at 0.356 and insider buys, the relatively low return on equity and assets suggest profitability isn't scaling as fast as revenue, and that high valuation leaves very little room for error. But the market momentum is strong, Brooke, with the stock trading near its 52-week high, propelled by AI optimism and expectations for strong Q4 earnings today. If they beat those estimates, it could definitely justify the valuation and improve those profitability KPIs. It could, Ethan, but the current KPIs show significant risk, and that single competitive threat from NVIDIA is a long-term concern. For now, the valuation is too rich for comfort, despite the AI potential. My verdict for AMD is stay away.
Let's discuss Snap Inc., SNAP. We're looking at two separate data points, but both paint a similar picture. One details a strategic spin-off of their AR glasses division, Specs Inc., to gain focus and capital flexibility. The other is a user YOLO post with comments expressing massive losses and calling Snap a broken stock that might go to zero. We've rated Snap as stay away for quite a while now.
That spinoff could be a game changer, Brooke. It allows the company to develop a distinct brand for AR glasses, attract new partnerships, and potentially unlock significant future value in the emerging AR market. It's a strategic move for future growth.
While the strategy sounds good on paper, the current financial health tells a different story. Snap is deeply unprofitable, with a negative net profit margin and earnings per share. The stock is currently trading right at its 52-week low, and insiders have been net sellers. The debt-to-equity ratio is an astronomical 186.48, which, combined with unprofitability, spells massive financial risk. A strategic spinoff is a future hope, but the current financial reality is grim.
You're right, the numbers are tough to ignore. Even with the future potential of AR, the current state of affairs is too risky. My verdict for Snap is stay away. Up next, SanDisk Corporation, SNDK. This one is generating massive excitement, with users reporting incredible profits and predicting the stock could hit $1,000. It's definitely one the market considers free money. We've seen a mix of ratings, from stay away to cautious buy, but our most recent verdict was a buy.
It's true the stock has had an extraordinary run, up over 2,000% from its 52-week low, and it's trading near its 52-week high. Revenue growth is also strong at 0.612, and insiders have been net purchasers. News about AI flash growth and analyst targets of $1,000 are fueling the fire.
Exactly. It's all about the AI story, driving demand for flash memory. This momentum, combined with insider confidence, makes it a compelling growth story.
However, Ethan, let's not overlook the red flags: a negative net profit margin and negative earnings per share. This means the company is currently unprofitable, and its sky-high valuation is purely speculative. While the AI story and insider buys are strong signals for future potential, the current numbers indicate significant risk. For high-risk tolerant investors, it might be a speculative play, but it's far from a traditional value buy.
It's definitely high risk, high reward, but the momentum, market belief, and insider confidence are too strong to ignore for a multi-bagger hunt. My verdict for SNDK is a buy.
Now let's turn to NVIDIA, NVDA. The discussion highlights their plans for new SoC models to challenge Intel and AMD. News is generally positive, focusing on their AI dominance and growth. Previously, NVIDIA has swung between stay away and buy.
NVIDIA is the undisputed leader in AI, Brooke. Their profitability is off the charts with a net profit margin of 53% and return on equity over 100%. Their strategic expansion into SoC models further solidifies their future. Jim Cramer even loves them.
I can't argue with those profitability numbers, Ethan. They are exceptional. But the debt-to-equity ratio of 9.102 is extremely high, indicating significant financial leverage and a high-risk profile. And critically, insiders have been net sellers, offloading over 2.4 million shares in the last 6 months. While the PE of 45.83 suggests massive future growth, insiders seem to be taking profits, which is a major red flag for me.
It's a powerhouse, but I understand the caution on valuation and insider activity. For me, the growth story is still so strong.
But the financial leverage and insider selling cannot be overlooked for a general investment. My verdict for NVDA, for now, is stay away. Now, let's turn to Alphabet, Google. Our data shows a strategic partnership with Gentle Monster for AI glasses, a forward-looking move into the wearables market. Also, their Waymo subsidiary is targeting a huge funding round. We've mostly rated Google as a buy in the past. And the KPIs certainly support that positive outlook, Ethan. Google has excellent revenue growth at nearly 16%, a fantastic net profit margin of 0.32, and an impressive return on equity of 0.35. They're trading near their 52-week high, and insiders have been significant net purchasers, buying over 2.1 million shares. This signals strong internal confidence. That's the key, Brooke. Strategic expansion into AI glasses and Waymo's success, backed by strong financial health and insider conviction, makes Google a robust long-term play. It demonstrates diversification and leadership in cutting-edge tech. Absolutely. The strategic moves are well supported by their solid financials. My verdict for Google is a confident buy. All right, hunters, let's recap today's picks from our AI-generated analysis. Investigate as buy: Western Digital Corporation, WDC; Microsoft Corporation, MSFT; Micron Technology Inc., MU; Alphabet Inc., GOOG; SanDisk Corporation, SNDK. Investigate as cautious buy: none. Investigate as speculative gamble: Tesla Inc., TSLA. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. That's all the time we have for today, hunters. Thanks for tuning in to the Daily Hunt for Multi-Baggers. We'll be back tomorrow with more AI-powered insights. Happy hunting!